Alright, this is gonna be chapter 2, act 2 on liquidity, and we're gonna dive into like harder topics, right? And we're gonna be showing you what liquidity is, what internal liquidity is, what's external liquidity, and how to even trade liquidity and like what role it plays in trading, right? And so market liquidity refers to how quickly and easily you can buy or sell an asset at a stable, predictable price without affecting its overall market price. Basically, if I were to place one order on a Nasdaq, it would probably move like nothing, bro. You know, unless I place like 3,000 freaking contracts, then probably it will move like a bit, I guess. But if I were to place just one order, heck no, I won't do nothing, bro. So that's what it means. High liquidity assets have high trading volumes, right? Like Nasdaq, and there's many active buyers and sellers, and minimal price gaps between trades. Meaning, if I were to place like, okay, if someone were to place like 100 contracts, it'll probably move like 0 point. It'll probably move like this much, for like 100 contracts. Actually, I don't know. But you can see the volume here increasing, 4.27k contracts to move 99 points. So that's what it means. See, volume 4,000 contracts to move like 75 points. I think that's what it means, And low liquidity means assets have few market participants and long transaction delays, severe price drops, and selling in a crush. Doesn't really matter. So let's say like a less liquid market. Let me give an example like soybeans. Okay, nobody freaking trades soybeans, right? And if someone were to sell like a ton of soybeans contracts, it will probably drop a ton as compared to selling like a ton of let's say like you sell 300 contracts on soybeans compared to you sell 300 contracts on Nasdaq. Soybeans will move much more because there's less people trading it instead of Nasdaq. There's more people trading Nasdaq. So that's what this means. And so liquidity is basically how liquid a market is. That's where the term liquidity came from, because you're ready to like it refers to how readily available they have orders in the market to execute a position, right? So if there's less people putting orders in the market, it's gonna be less liquid because I'm gonna have to wait for someone to buy my contract. But in this market, it's like literally instant because there's just that many people and orders in the market. So I hope you get what I'm saying over here. That's basically just what the term liquidity is. And well, you don't really need to know all this actually. It's just good to know like what liquidity is, which is basically just how much orders in the market they have, to move price. And now we're getting into internal and external. These two come hand in hand. Internal, let me draw it out for you. So right here we have a tree candle formation, okay? And this is what price looks like when there's no internal liquidity. It's all filled. Like price is over here, right? There's wicks. We look at the wicks, we see that the wicks cover each other for the candle's body. But look what happens now. If I take these wicks and they become shorter, suddenly there's only bodies here, right? There's no wicks. So if I take this space and I draw the box so you can see, that becomes the fair value gap. This is what we call a fair value gap. Probably heard of it before. Fair value comes from like order flow, okay, but you just gotta know it's a gap. The name is called fair value gap. We call it FVG for short, just gap. So this is what internal liquidity is. Of course, I'll show you the purpose and everything in the trade section. But for now, all you gotta do is, it's like a magnet, okay? Price goes down over here, and then once it hits it, it's supposed to go up, right? And if you notice, there's this midline here. I'll get more into that later. It's called a CE, or consequent encroachment. It's just basically the midpoint of the gap. Now, more on the midpoints of this fair value gap here. Usually, price will want to go down into the midpoint, right? The midpoint is the most reactive area, okay? And it's the most important one. all you gotta know is it's an important point, and you should always enter your trades at this point, okay? Or it actually depends. Sometimes it's safer to enter your trades here depending on the condition of the market. Sometimes the market is very, very bullish. It will only tap into it a bit or not even tap into it at all before going up. Sometimes when the market is kind of choppy, it will fill it all the way and then it will go up. That means it will come down and over here, and then it will go all the way up again like this. You'll fill it, then it'll go back up. So that's more advanced topic. I'll get into that next time on market conditions. Now, what happens if price does something like this to the fair value gap, right? It responds to the fair value gap with another fair value gap. Okay, so very simple. It's actually going to be an IFVG now, meaning inverse fair value gap. So same properties, it's going to work like this, okay? Let's say market were to go up to it, it would now, instead of a speed boost up, it's going to be a speed boost downwards, okay? Because at first it was a buyers are in control, now sellers took over, and so this would add like a speed boost for sellers to go down, okay? And if it were to inverse back up, that means like another closure above like this, it would just be an inverse fair value gap also, but this time it's above again, okay? Simple as that. And so I drew out a little diagram here, and basically it's just a swing high, bro. Those are what you call external liquidities. Let's say there's a fair value gap here, okay? If this is internal, this is external. If that makes sense? Internal meaning like inside, it's a gap. External means it's outside, it's a high. We learned swing highs and swing lows before, meaning this is also a liquidity right here. Now, getting into why we call this liquidity, because if you think about it, if someone were to, no, there is people that shorted here, okay, that's why the market moved down. So there's people that shorts here, that shorted here, and they're gonna put their stop loss above here, right? Of course, there's gonna be a stop loss right here. Let me just show you right here. Alright, let's say I did short here. Of course, I'm gonna trade with a stop loss, otherwise I'm stupid as shit, right? If I short here, my stop loss is here. That means when price comes up all the way up here, it's gonna touch my stop loss, and I'm gonna execute an order, right? So that's what it means when external liquidity. No, frick. That's what it means where liquidity is just resting orders, okay? Because it's people's stop losses and everything. Ideally, and also in the bottom over here, I have a long order. Let's say I longed from here. I'm gonna have my stop loss down here, right? Unless you're stupid, you trade without stop loss, then you're gonna lose like however much, bro. Okay, don't trade without stop loss, guys. And if I were to long from here or anywhere here, you know, my stop loss is gonna be down here. So if price were to move down here, I'm gonna get stopped out. And what does getting stopped out mean? Stopped out means you execute a sell order. If you buy, you gotta sell here. That's what a stop loss is, right? Basically, you took a loss and you're cutting a loss short, and then you're selling here. So you just got kicked out, you know. So when you get kicked out, you execute a sell order if you're taking longs, and then you get yourself out of the market. So this is what resting orders are. Imagine a zone here, and that's what liquidity is, right? If market were to go down over here, some people have their stop loss like way down here. That's why like market goes all the way down here, right? They just have it like where they entered, right? And so if market were to go all the way down here into this pool of liquidity, why we call it pool of liquidity, because it's not just me having my stop loss here. It's a bunch of other people that bought here or even here, and they have their stop loss down here, right? So market goes down all the way down here to get us all to execute the sell order. And since we are all selling, the big people who want to buy at a discount can buy, because remember, we have to we have to buy we have to buy in order to buy. We have to buy it from someone who's willing to sell. That's how the market works. So if I show you the DOMs, it's basically just people matching each other's orders, right? Let's say I want to buy at this level, okay? I have to wait for someone to be willing to sell at this level. So it matches together, right? So if nobody were to sell over here, we can't buy. I mean, the market makers can't buy. The big people can't buy, right? So they need us to sell here for them to be able to buy. That's why they push price down and then they say, oops, I'm just actually gonna buy right now using all your sell orders. So that's what liquidity sweep is. Now that you know what is liquidity sweep is, of external liquidity, right? We're gonna go ahead and go into the real trade example, right? So over here in the chart, we have a fair value gap. Remember the tree candle formation, and then no wicks, just the body. This is basically what it is, right? So price makes an inefficiency is what you call it, okay? It goes by many names, right? And depending on the scenario, it can change its name to like inverse fair value gap or whatever, you know. This is just a normal gap, and you see that price formed it using this tree candle formation, and it went down to it, and then it got up. So a little bit of a background story as to why this works. You don't really need to know it. You just need to know what it does, okay? But basically, if you were have to, yeah. So if I whip out the volume, volume profile, this is a bit advanced, okay? But like I said, you don't really need to know this. But what it is essentially is a gap in volume. That's why it's called inefficiency, right? If people weren't selling over here, that's why it's just a huge bullish candle right here. And so when price tries to go down here, it immediately gets bought up by the buyers, and we just fling up, right? This is why this is called a bullish gap, a fair value gap. That's what it's called. And over here, this is literally what liquidity sweep is. So the people who went long from down here and pushed price up, have their stop loss around this area, right? They have their stop loss around this area. So once market went up, okay, blah blah blah, it went to sweep it. You see this? Yeah, it swept that low because people's long orders, like right here, if I were to long from here, I'll have my stop loss like probably around here or whatever, right? And I can trace the break even, okay? Meaning my stop loss is where I entered and I lose nothing if price were to come down here. And so price will come down here and force me to sell, and then the big people who have the money and want to buy, right, they can push price up again because you have to buy the sell orders from me at a cheaper price. And you see here, price swept liquidity and just ran up here. That's essentially what a liquidity sweep is. Alright, now I'm in the innercircle.trader.net. It's just a resource. You can go here and learn from it. It's really helpful. They give like textbook definitions. And so internal range liquidity is just fair value gap, like the tree candle formation I told you. And it acts like a magnet. Price goes to it, and then since it's a bearish, this is a bearish fair value gap, so I expect price to go to it and then be repelled by all the sellers, because remember, this huge candle is called supply sellers, and so over here there will be sellers in control as well, so it will push price back down if it's a bearish fair value gap, which aligned like this. And same over here, 4-hour can align with lower time frame. This is a 15-minute time frame, this is a 4-hour time frame, you know, and so it can align and it can work together, and you can see clearly. And so external range liquidity, this is basically what it is again, like I just said. It's just a high right here, and external liquidity is here. It goes to it, then it can reverse or it can keep pushing. That's why you call breakout if it keeps pushing. But if not, they force us to sell if we're going long, and they take our sell orders and just buy it, and then they push price back up. Same thing over here. If they were to go up, they take our buy orders, buy stops, because we're going short, remember? We sell and we're negative shares, and once we get out, we have to buy back into 0 shares. And you have to pay back the broker our share that we borrowed. That's how shorting works. And so if price goes up here, and when we are shorting from here, we get stopped out through buying, and so they will sell our buys, right? And then they will go down here. And more on how you can use liquidity in your trades is you would always want to frame your trades based on liquidity, because that is what moves the market, right? And so obviously you're gonna have to have kind of a liquidity sweep right here. You can trade continuation. Let's say you buy here when it breaks out, and that's what you call breakout trade. But I like to use liquidity sweep, and then I'll have like my buy somewhere close here, right? Say this is the liquidity I'm working with, right? And I'm gonna buy somewhere here. Okay, it's a very tight spot, oops. But I'm gonna buy somewhere here, and let's say it's a fair value gap somewhere here. I will combine the sweep of this external liquidity and enter in the fair value gap. And then my trade will look something like this, right? Stop loss around here, and then I would take profit around, let's say here, right? This is what the trade would look like. And let's say people are greedy, they want to aim somewhere here, and then their stop loss is still here. Price would come down and sweep it and force them to sell. Then they buy it again. So that's how liquidity works. Hope you learned something in this video, and that's it.